Hey traders, Raghee here. Happy Thursday, everybody. Welcome to Charts and Coffee. All right, so it's Thursday the 10th, and we are in that pit bull low window. Pretty good chance that we probably saw the bulk of the pit bull low put in as we sold off into the close yesterday. And so I'll be watching pretty darn closely for that. Of course, as if we don't have enough going on over the next handful of days, we did have some major data this morning by way of, let's scroll down here. All right, you can see right there, we did have some major data by way of the CPI. Now remember, in this current environment, jobs and inflation are, and not just the CPI, but the PCE as well, are on the Fed's radar. Now remember, the Federal Reserve continues to do what? They continue to focus on the narrative that inflation is transitory. Well, when we print a 0.7 versus a 0.5 compared to what we saw last time, which was that really outsized print, this is going to be pretty bullish for equities, because what does this say? Well, the market thinks, well, one, maybe the Fed's right. Maybe inflation is transitory. And two, this then means they'll stay on their current monetary policy path. Step one, print money. Step two, buy assets, which all then means that the balance sheet will continue to move higher, and we know that equities love that. So that's where we are in terms of the narrative for this window between this pit bull low and next Friday's triple witching. All right, so let's go ahead and get to our questions. Good to see everybody. All right, so let's see here. All right, so first question. Line watcher, is my disgust? Gosh, does my NASDAQ commentary come across as disgust? It shouldn't. It's really just focusing on where the clarity is. So my sort of preference for clarity would demand that I don't spend a lot of time looking at the NASDAQ. So it's definitely not disgust. In fact, the current macroeconomic environment of reflation should, in the ideal sort of scenario, the ideal reflationary environment, should be somewhat beneficial to tech. Now, remember, every single macroeconomic environment is going to have sort of a different cast of characters. In this case, we do have what's happening with the bond yield. I think, part of the narrative we're seeing right now is that bond yields are keeping tech, because tech is more sensitive to that higher yield. It is keeping tech probably in pretty good check. But, regardless of the reason, let's say, you might think to yourself, Rog, I don't follow, nor do I necessarily understand how to track macroeconomics. No worries. Remember that as someone who looks at the charts price action reflects what is known and discounted into the market. So the news, the sentiment, fundamentals, whatever, are ideally priced into what you're seeing on the chart. And so there's not a lot here that tells me I should be really bullish on the NAS as a trend follower. So yeah, it's definitely not discussed, but it's, again, if I spend an inordinate amount of time looking at the NAS, that means I'm not looking at the higher quality trends in the market. So as much as it's important to have a watch list, I think it's equally as important to have a do not watch list. And that's kind of where the NASDAQ's landing for me right now, sort of on this do not watch list, because if I'm giving that market attention, then that's robbing attention from other spots in the market, in the broader markets, right? So the NASDAQ, that tech sector, really doesn't have a lot of my attention. And that has a lot to do with what we talk about in Sector Secrets, which is understand what's inside the NASDAQ in terms of the individual sectors and the individual stocks. So thanks for the question, Line Watcher. All right, next up is if we see a pullback due to CPI figures, do you see current levels staying out of reach for the next 3 weeks? Ben, I don't, and nor does anybody, know what's going to happen over the course of the next 3 weeks. We have probabilities. We know that certain trends are more likely to continue. We know that there's certain overhead resistance in the case of the S&P all-time highs, but I don't think in time horizon and then predicting within that time horizon. That's pretty futile. I've never based my trading on not only finding the direction, but also the window in which that direction is going to uphold. So that's never been part of what's necessary for me to be a winning trader. And that's worked out pretty darn well. So the truth of the matter is I don't know. And for my approach, it truly doesn't matter. Now, I don't see a pullback with the CPI because, again, the CPI printing that 0.7 versus the expected 0.5 is pretty much in line. It's not a shock. It's not a shock, meaning we see a huge print in CPI suggesting that the Fed's narrative of this being a transitory inflationary environment is incorrect, right? People are thinking, all right, well, if the Fed's right, then monetary policy is right. And monetary policy currently is very supportive of higher highs and stonks, right? So I hope that makes sense. So I'm not expecting a pullback, nor did we get one. All right, so why is the initial balance important in day trading? PH, it's funny. I actually find it's secondary to the clearing range or the opening range. I actually find that secondary to that. I think the most important part of, if we're looking at the two ranges. So for those of you that don't know the technobabble of clearing range and initial balance, the first 30 minutes after the bell is the clearing range. The first hour after the bell is the initial balance. So if I am looking at the first hour, that's really going to be for me indicative of what I might expect throughout the remainder of the day, maybe throughout the doldrums, the midday doldrums, the 2-hour block between 11:30 and 1:30, and then going into the afternoon. So for me, that initial balance is more indicative of maybe a continuation, sort of a grind higher or a grind lower for the remainder of the session. But for me, and my day trading is really built on the first 2 hours of the day. I only care about the first 120 minutes after the bell. So I'm day trading the first 2 hours of the day. That frees me up to, look at other types of time frames and setups, not day trading 9:30 to 4, which I actually do not find to be, on balance, a profitable approach to short-term intraday trading. The first 2 hours of the day are the perfect window for that. And then the first 30 minutes of the day for me are the most indicative to what I will likely see in what I'll consider the AM session. And if some of this day trading, intraday trading is interesting, or you have questions about it, next Wednesday at 8 p.m., June 16, 8 p.m., I have a webinar coming up solely dedicated to the topic of the way that I day trade. So pencil that in on your calendar. And we'll be definitely diving into topics like the clearing range during that talk. All right, so next up is, hey there, James, question about Key and KRE. All right, so let's take a look. KRE, when I'm looking at small caps, when I'm looking at the Russell, whether that be via IWM or RTY, the part of sort of the small cap narrative that I think has been a relative outperformer has been the regional banks, the KRE. And of course, Key is a heavily weighted name, but remember that the KRE is not a high concentration weighted sector. It's not one of those sectors that tends to be really important in terms of, if we're breaking down the IWM and we're breaking down high concentration weighted sectors, what we want to remember is the stocks and the sectors that are going to be influential are going to shift, and there's not going to be just a handful of names that are far more impactful, that are going to be outsized in their influence on the underlying sector. So Russell, KRE, they're tricky. So be careful with the weighting, but I hear what you're saying. Key is tracking pretty nicely with KRE. So this is what I'll say, James. We've played Key in the past. We've played other names in the KRE, but I'll tell you what, in a high concentration weighted sector or index, I do like individual stocks. But in non-high concentration weighted ETFs and sectors, what are examples of that beyond KRE and IWM? XOP, the oil explorers, would be another one. So in those situations, I just assume go with the tide. I just assume go with the broader narrative, the sector. So I like Key. It's likely going to track with KRE, but I actually like KRE a little bit better. And you're seeing, by the way, on both of these, so good eye, they're pulling back into the wave. They're predominantly double green markets, and both of them have our little telltale Darvis signal right in here. So right there is our Darvis signal on KEY. And then, we'd like the broader sector to be in sync with that. And boom, there it is on KRE. So I like them both, but I probably marginally like KRE a little bit better. But good eye, and I think it's a good setup. All right, so let's see. Are the CPI numbers below where they need to be for the Fed to take any action? Look, the Fed's going to talk before they do anything. In other words, they've got to prepare the market. And I will say the Federal Reserve has been, generally speaking, pretty good about sudden shifts in monetary policy. The biggest two shifts that I've probably seen during Powell's tenure has been in 2019, when they very nonchalantly, in a Bloomberg interview, televised Bloomberg interview, announced that they would be patient. And that really put in the V bottom in the early part of 2019, as that was the secret code for they're no longer going to be hiking rates. You remember the rate hiking, the tightening cycle into Q3, Q4 of 2019. And I'm sorry, 2018 to 2019. So that put in the V bottom in 2019. In 2020, well, we know that the Federal Reserve went full on emergency, went full on empowering the Treasury to buy high yield corporate debt and junk bonds, bonkers. But they really did express to the market the degrees to which they will go to support equities. And that was yet another V bottom that we saw early in 2020. So other than those types of things, for the most part, the Federal Reserve is going to have to prepare the market for a taper. And that's just going to be words. They're not going to suddenly taper, but we can see perhaps shifts in their action by way of the velocity of the M2 slow down, or M1 even slow down. That's the money supply. And then that would then, the knock-on effect of that would be a slowing of the asset purchases. The taper is going to come first. I know that yesterday, I think there was some brouhaha about the fact that Janet Yellen actually mentioned that higher rates would be good. I think that was more of a societal, cultural type comment. Very odd for the Treasury, the Secretary of Treasury, to mention that. Janet Yellen is a really interesting Treasury Secretary, because every now and then she still speaks out like she is the head of the Fed still. So it's kind of an interesting thing to watch a lot of what Janet Yellen says, and probably, Jay Powell picking up his phone and texting her, "Stay in your lane, Janet." So it's kind of an interesting back and forth we see between what she's willing to say, even though she's not the head of the Fed any longer, and how the market is going to respond to those things. So it's going to take a little bit of communication. I mean, look, the Federal Reserve is not even willing to talk about when they're going to talk about the taper. So I think we're still pretty far off. All right. So next up is XLB. Yeah, Alex, we've got XLB on the radar. That is a market that I am bullish in. Remember that we're still in the window for the pit bull low, and that if we do see that pit bull low, maybe we'll see some minor lows or inside days today. I would be opportunistic on the lows that we could possibly see through today, maybe into tomorrow. That really is this 3-day pit bull low window. And then I'm actually expecting some stabilizing of the broader markets. and then some outperformance in the outperforming sectors. XLF comes to mind, XLE comes to mind, XLB is a relative outperformer. So there are windows into where the relative outperformance is, where these double green uptrends still exist. None of that is happening in tech, maybe borderline in, say, the XLC. Most of that's happening around energies and financials. And so that's really where most of my focus is going to be. And materials is actually not just an uptrend, but it's a reflationary uptrend. Energies is not only a reflationary uptrend, but it's also a reopening uptrend. So that benefits from both those factors. So thanks for the question. All right, next up is gold. Do we like gold? Really close. That low, that wick was tantalizingly close, about 5 points from where I'd be willing to buy gold, which is along the 34 EMA wave. The top line of the wave is the 34 EMA on the high. So if I'm looking at the 34 EMA on the high on the daily chart of GC, I would look at 1866, say 5, and I'd be willing to start building a position, scaling in, not just backing the truck up, but scaling in to a position starting at that level. And then think about what else is likely moving at that point. And likely you're going to find silver is going to move along with that conversation. All right. So that is what's going on gold. Thanks for the question. All right. Next up is XLP. Yeah, Mike, XLP is in the zone. Like this one a lot. Absolutely. Yes, if you followed if you followed the update that I did just the other day on currencies, the free video for futures, I've been talking about 6C, 6B, and 6E. And yes, we're getting very close to the zone, but I'm actually preferring 6B and 6E right now. So those of you that are watching this or in the futures room, you know that we talked specifically about the zone to be buying in 6B. 6B fired off, 6E got very close. That also opens the door up to FXE and FXB for potential buys using the currency share ETFs for those of you that don't like to play either the Forex markets or the currency futures, which is fine. There's actually 3 ways that we can play currencies in these markets, and that's the ETF, the futures, and the foreign exchange. So those are the 2. C is getting close, but E and B are much closer or in their zones. All right, what do I think of McDonald's? Of all the things that I could look at, I don't want to be short McDonald's. And I think there's probably a pretty good argument for a potential momentum breakout. Here, I've got plenty of Darvis signals. Take a look, showing me where the buys are. Here, got another one here along this Darvis level right here. And so that tells me the closer I'm trading to about 230.50, the more likely I am to be a buyer and look for the market to move higher. But what's nice about sort of front running the momentum, which is what I like to do. So if we're in a compressed environment, if we're in an environment where the candles have gone consecutively blue, and I can see that markets are getting, this particular market, McDonald's, are getting more and more and more stuck in a range, we don't know how long that range is going to be. So you definitely don't want to put a time crunch. Give yourself plenty of time. But one of the most important things about, I think, waiting for momentum to break is knowing that, A, you can front run it, and B, if it doesn't break through the momentum level, you're looking at an unrealized profit up at the top of the range. I like those odds. So I'm going to focus on the lower end of the range and sort of front run the momentum. Okay. All right. And just like that, we are getting ready for the open. I'm going to head on over to the futures room, prepare for the open, do a little day trading in the indices, ETFs, and maybe some stocks, and keeping an eye on the currencies and energies as well. So thank you as always for joining me for Charts and Coffee. I will see you all tomorrow. Be good to each other.